Hi, everybody. Welcome back to the 10th of an Hour with Griffin Bridgers. For today's episode, episode 43, we're going to look at a certain type of life insurance classification called the modified endowment contract and how that fits into estate planning. Now, to preface today's discussion, there's a lot of rules and pitfalls that surround insurance policies, especially paid up policies. And by no means is this going to be a comprehensive discussion. Really, we're going to hit some high points. It may not capture the full story, so additional research, if you're looking at this, is necessary. And as always, this presentation is not intended to substitute for legal or tax advice, especially on this subject. But we're going to look at maybe some issues to think of that you wouldn't otherwise think of if you were dealing with estate planning for modified endowment contracts. Now, what is a modified endowment contract? Well, generally, it's a life insurance policy that fails what's known as the 7-pay test, and we'll look at that in a minute. But really, what that means is that if there's a policy that accumulates cash value and you have advanced or accelerated premium payments, then the rate of acceleration of those premium payments could flip the tax treatment of the policy from FIFO to LIFO. That means first in, first out versus last in, first out. So if you have traditional FIFO treatment, what that means is that any cash you pull out of the policy permanently is treated first as just being a return of your investment, so premiums paid and things of that nature, and then from accumulated tax deferred income like cash value and dividends. And then if you have LIFO treatment, it flips that on its head, where the cash out first comes from the tax deferred portion of the policy. So your cash surrenders would be out of cash value and dividends, and last would be a tax-free return of your premiums paid. And it's also important to note that this doesn't just apply to cash withdrawals. If you have a modified endowment contract, any sort of use or benefit from policy cash could be taxable, such as a loan from the policy proceeds, which would usually be tax-free, or even a pledge of the policy for another outside loan from a third party. Any of those could cause taxable treatment of the loan itself. Now, the 7-pay test is one where it's easier to just rely on the insurance company or actuaries to figure out when and if this has been violated. You can't really do it justice in this discussion, but a good way to think of it is if you have any sort of advanced premium payments that by themselves exceed the sum of premiums that would be required over a 7-year period to cause the policy to be paid up, then you'll have a modified endowment contract. Now, this could also apply not just to accelerated premiums, but any sort of benefit reduction or material change in the policy as well. Now, as with excess IRA contributions, you can fix MEC status if the excess premium is returned by 60 days after the end of the policy year or the policy anniversary. Otherwise, there are some other ways the IRS allows you to fix it, but you may have to, for example, do a 1035 exchange into an annuity if you wanted to fix this after that 60-day deadline. Now, from a tax perspective, the rules for modified endowment contracts are derived from the annuity rules as well. So any sort of use of policy cash is subject to tax at ordinary income tax rates on a LIFO basis, as we mentioned, unless you can annuitize it somehow, and we'll look at that in a second. But you also have, like with annuity distributions or withdrawals, an additional 10% penalty tax that can apply if you use the policy cash prior to reaching age 59 and a half. Now, you can get around that if you take a distribution for disability or take 72T distributions, which are structured to be paid out over your lifetime in equal amounts. So if you annuitize this could potentially help you to give some relief, but not full relief necessarily. And more what we're looking at today is the fact that from an estate planning perspective, there's lots of things you can do with a life insurance policy, maybe to reduce your estate tax burden. Things like loans, the pledging of a policy, the assignment of a policy, and even split dollar arrangements. And any of these may be off the table, especially in the estate planning world, if you have a modified endowment contract, because of the heavy tax load that the status as a modified endowment contract carries. Now, it's important too with split dollar arrangements to note the recent cases of the last few years in Morissette and Cahill, where split dollar arrangements that were private caused excess estate tax when not done correctly due to retained control of benefits through the split dollar agreement itself. Now, notwithstanding the additional income tax issues with the MEC, split dollar arrangements may be, difficult to substantiate and do correctly in general, and you don't want to add this additional layer of worry where you're already having to look at the estate tax consequence, and you may also have to look at the income tax consequence as well. Now, the most common estate planning transfer I'm going to look at is in a situation where you want to get the policy into an irrevocable life insurance trust, an ILET. And you can do so by sale or by gift. If you do so by gift, you have to live for 3 years beyond the transfer in order to avoid estate tax on the policy death benefit. Whereas if it's a sale, you can avoid that estate tax from the inception of the transfer, but at the same time, there may be some income tax liability on the transfer. And in order to avoid that income tax liability, especially the MEC tax liability, it's important for the ILET to be a grantor trust. If you're going to use a non-grantor trust, you should only transfer the policy by gift, really. And then if you're selling a policy, you should make sure it's not secured in any way by the policy itself. So another layer to this might be looking at, instead of just funding the ILET with the policy, you may want to make sure that the ILET has enough other assets to pay the purchase price or note without having to rely on the cash value of the policy, because any purported pledge of that policy that may be required by the trustee's duties under state law could cause income tax to the grantor or to the trust itself. And if it's to the trust itself, or even the grantor, if they're under the age of 59 and a half, you could have that additional 10% penalty tax as well. Now keep in mind, if you're gifting the policy, traditionally with a MEC, because of the advanced premium, you're going to have a much higher cash value, which means a high use of your gift tax exclusion if you're transferring by gift. Plus, as I mentioned, the 3-year rule was going to apply. So once the policy is in, you also need to be aware of how that policy and the proceeds of that policy could be used within the ILET itself. Now, prior to the death benefit being paid out, if there's any distributions of policy proceeds, you're going to have a very high income tax load on those at the trust level if you have a non-grantor trust. And it's important to note too that your look-through rules that apply to annuities, which we'll discuss another time, are going to apply as well. So, beneficiaries who are under the age of 59 and a half may have to pay penalty tax on trust distributions during the life of the insured. And in that realm, crummy rights may not work as intended. And in the worst case, I could see a scenario where the IRS maybe looks at the crummy rights as almost in essence being like a pledge of the policy or a use of the policy cash value. So that's kind of a stretch, but I wouldn't put it past an aggressive IRS agent to try to take that type of a position if it came up. But that is a smattering of the issues that can come up with estate planning for modified endowment contracts. But once again, this isn't an all-inclusive policy. It's important, first off, just to avoid modified endowment contract status, but if you haven't avoided it and you can't fix it, you should be aware of the issues that surround estate planning during the life of the insured for the policy itself. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. And thank you again for listening to this episode of The 10th of an Hour, and I look forward to seeing you in the next one.